Hey, everybody. Paul Meeks back with you. We've had a little bit of a hiatus. Here we are with Tech Tune Up with Paul Meeks, brought to you by our good friends at Benzinga. Thanks for their support. I'm down here in Charleston, South Carolina, at the HQ of this firm, Harvest Portfolio Management, in which I manage a tech portfolio, among other things. So in this program, we highlight the week's most important tech news, but don't limit it to that. Sometimes these individual companies give us tells that are much more broadly applicable. And of course, we want to leave every program with some actionable trading ideas, not always just long, but sometimes short ideas too. So let's get into some of the important stuff of the week. This is a theme that I've talked about before relating to AI buildouts all over Southeast Asia. Microsoft, last week I reported, was going to invest over $2 billion in Indonesia. And now they're right back at it. And they are building another big facility in Malaysia. And so this is very interesting because we were outed during COVID with our reliance, US tech that is, on China for our supply chain. Of course, that got wrapped around the axle. And now companies are desperate to continue to grasp the low-cost labor internationally, but not be so dependent on China. Now, the company I worry about the most in that regard is Apple. Apple really depends on China, not just for manufacturing, but also for a big end market. So stay tuned for that. All the tech majors are spending a ton of money for AI infrastructure build, and they're trying to sprinkle the infield all around Asia, excluding China. So the next is very interesting. We've talked about on this program the real threat, not just in the United States, but with the European Union, with regulations on all sorts of tech companies. And this past week, Alphabet had final arguments in its case against the Department of Justice and several states' attorneys generals over anti-competitive behavior in search. Now, of course, everybody knows that Google has about 90% of the world's search market, but that's a great business model. But what happens if there are changes in the business model? Could be really, really negative for the digital advertising model. So we'll see what happens. This is a bench trial, right? So they don't have to go in front of a jury. The judge has listened to both sides' arguments and will make a pronouncement probably next week, maybe a couple months from now. But man, really interesting example of tightening the screws. Doesn't matter if you're Republican or Democrat. It's going all over the place on Alphabet. Next is Meta. Meta is very interesting because I'm always looking for companies that just don't talk about AI and all the wonderful things they're going to do. They actually have a viable product that looks like it's going to be accretive to their finances. And so Meta is really pulling out all the stops with generative AI and trying to incorporate that into their digital ad tools. And as you may know, digital advertising, not just in the States, but all over the place, is totally dominated by Meta, the old Facebook, and by Alphabet, the old Google. And so if they can actually show me kind of a old technology updated and improved by the new technology, then I'll believe that AI is a real deal. But I haven't seen enough of these case studies yet. Next, here is a stock called Duolingo. This had been on my buy list, and shame on me. This company reported results 2 days ago. Yesterday, the stock was down a full 18%. Now it's stabilized, but here is an example of a company where the expectations are just so high, and even though they delivered the goods and even more so for the quarter, gave updated revised upward guidance for the year, the stock had already come up a lot. I see in situations like Duolingo buying opportunities when the fundamentals are still sound, but you have a dip just because uber high expectations haven't been met. So anyway, I'm looking at Duolingo. Now, this is the language learning app. The logo is the green owl. I'm looking this at a possible buy at its 200-day moving average support, which is about $189 a share. If we get there, if we can stabilize there, if it looks like it's a strong floor, I'm probably going back in even more aggressively on Duolingo. Next, Airbnb. This is a company that's always interested me. You would think Airbnb, with its brand and its total domination of its market, they would have steadier, consistent results. But they missed another quarter. This is a company, I think it's managed well. Their CEO is very well regarded. But can you trust it? Because they have positive earnings surprises, then they have negative earnings surprises. Is it because that management gives poor guidance to the street, so a negative earnings surprise is inevitable? I always have been perplexed as to why can't we gel the awesome brand, the awesome product, with these results that sometimes aren't so awesome. Just weird. I don't know what's going on. Next, Roblox. This is a company, if you have ever heard of it, it is an online platform for software developers to create video games. And they had a nasty quarter, stock way down. Maybe this tells us a little bit something about not all is well in video game streaming. And you may recall I've touted a couple of shows ago, if you go into that space, I like very much Take-Two Interactive, ticker symbol TTWO, because I don't know when it's coming. I don't know if it's going to be January 1st, 25, or somewhere between the end of the year and December 31st, 25, but here comes Grand Theft Auto 6. And when they release that software, their earnings per share are going to probably double or triple overnight. And so hold the phone, get ready to buy Take-Two Interactive. That's the only stock I trust in this space. Next, let's talk about ARM. ARM is the British semiconductor company that recently had an IPO. But the interesting thing about the IPO is they only sold 10% of the stock to the public. So 90% is still held by the Japanese firm SoftBank. And the reason I tell you that, when only 10% of the shares float, you can have extreme movements on any perceived good news and extreme movements on any perceived bad news to the downside. So they had a quarter which was in line, but again, the stock had popped. Part of it was the short squeeze from the small float, and they reported that their earnings going forward, the revenues are going to be 20% plus. That's pretty good, but not good enough for the street because the stock got hammered. Next is Apple. We got to stay tuned with Apple because the first, or actually second week of June, they're going to have their software developers conference where they're going to, for the first time, really delve into their AI offering. Let's hope so, because so far they've shown no AI game. And this company reported its earnings about a week ago, and I thought their results were really uninspiring. I haven't been on the Apple bandwagon in some time, and it's been a good call on my part. But they announced a $110 billion stock buyback. That sounds great, right? They're buying back their stock, but that is essentially, through financial engineering, boosts their earnings per share. It is nothing operational. And so I don't give Apple or anybody credit for boosting their earnings per share just by lowering the denominator in the earnings per share calculation. So anyway, Apple has not grown for about a year and a half. I don't care if they pay a dividend. I don't care if they buy back their stock to juice their earnings per share. You got to show me revenue growth, because if you don't show me revenue growth, you're not a tech company. This is interesting. The next news item here, not the Chinese, but the US have pulled the export licenses from both Intel and Qualcomm because their chips were found in products from the Chinese consumer electronics and telecom equipment vendor Huawei. And this is just another example of the tarnished relations, which is super important for my sector, between the US and the Chinese. I wish, in my heart of hearts, and I'm a patriot as much as you are, but I'd love to go back to the days where we had kind of a mix of competition and cooperation. because they need our designs, but we need them right back. And we may need them more than they need us. And so this is just another sign of bad tidings for two pretty important American chip companies. Next, we have Shopify. Shopify is kind of the minor league version of Amazon. They had a poor quarter, and one of the things that they cited on their quarter was a real slowdown in consumer spending. Wow. The U.S. economy, gross domestic product, is 70% driven by consumer spending. And this is a good thing, bad thing. The bad thing, obviously, is it whacks companies like Shopify. The good thing is it shows that the economy is slowing down, and maybe it brings inflation down with it. And so maybe our central bank, the Federal Reserve Board, can finally pivot to lower interest rates. So this news is bad for Shopify and probably some of the other legacy retailers and even e-tailers, but it could be signs that if the economy and inflation start to abate, we can finally get to what we desperately need for tech and aggressive growth stocks: lower interest rates. Uber reported a quarter which kind of surprised me to the downside, and the stock got whacked. I've always felt in rideshare that Uber was the best and Lyft was a pretender. This time round, Uber gets whacked on its quarterly results, and Lyft has a big move to the upside. But when I take a look at Uber's results more carefully, I see that they took some losses in their venture capital portfolio. It wasn't really an indication of that much of a slowdown in either their rideshare business or in Uber Eats. I think this could be a buying opportunity in Uber. And Lyft, I always think of them as a second-class citizen. So maybe you sell the Lyft into strength, because there has been some recently, and you buy this Uber dip. We'll see. Next is Reddit. Reddit had its first quarter as a public company, and the stock really popped on the news. Of course, the stock had done pretty poorly since its IPO, and I don't believe it. I would sell Reddit right now into strength, maybe even consider shorting it, because when it comes to digital advertising, which rules the roost for this company, it is game over in favor of Alphabet and Meta. What they talk about on their conference call to get everybody excited is that they're going to sell all their data to these big tech companies that are going to use their data to populate their large language models for AI. I don't think so. I think so far they've done $60 million in contracts, which isn't even 5 or 10% of their overall revenue. So they're essentially got a really challenged core business. They're talking about doing some of this other stuff in AI. I believe it when I say it. But in the meantime, do not buy that stock. Consider shorting it. One of my better calls recently with my AI infrastructure theme has been Arista Networks, ticker symbol ANET. They had a gangbuster quarter. Stock did really well, and it was already trading near an all-time high. This is one of my AI pick and shovel stocks. This is a data networking company that supports with their plumbing the data centers of all the tech majors. Like, for example, Meta is one of their biggest customers. And Meta said when they reported earnings a couple weeks ago that they are going to spend $40 billion this year on capital expenditures for AI. They're spending 40, Amazon spending 60, and Microsoft and Alphabet are spending another 40. So anyway, if these guys end up being the plumber for the data centers, for this AI build out, there are tens of billions of dollars of capital expenditures coming, and they're not going to peak in 24 or 25. They're just going to grow from there. Next, we have Rivian. Rivian is one of those EV companies, sucks, had a poor quarter. I don't know if Rivian even makes it. They seem to have a cool product, but as I've said before, the electrical vehicle market is essentially uninvestable. And I've been absolutely right with my Tesla short over time, but it's really hard for these guys to make money. And Rivian showed it, and Tesla is a world of hurt. Tesla's had a little bit of a rebirth in its stock price recently, only because of some Elon Musk BS spin. So anyway, stay away from EVs. The next is Tesla. And I told you that it's only getting worse. But here's something that's happened in the last week since we last met with Tesla. So the Department of Justice and the Securities and Exchange Commission are coming after Tesla and Elon Musk for inappropriate comments that they made about their business prospects. Now, in the past, Musk has been the Teflon man, right? Nothing has stuck to him. But this time it is pretty serious. And it seems to me that the evidence against is pretty compelling. And there may be, believe it or not, real criminal charges. And that comes at the worst possible time because their business is doing poorly. So we'll see. I really think that this could be a new level of scrutiny, a new level of regulations, and finally maybe bites this company in the ass. Next is Robinhood. Remember, Robinhood was a meme stock trading platform? They still are. Now they're saying that they're a bank and they have a credit card, some other stuff. I don't think they're going to be scaring JP Morgan anytime soon. But this kind of repositioning of themselves has taken their stock up recently. I think it's totally unjustified. I think these guys are in some problems. And also they are in trouble because the regulators have come after them saying their sale of cryptocurrencies was illegal because they should have registered these securities first with the Securities and Exchange Commission. So we'll see what happens because they face a really big legal threat. Next is a company that I panned on this program. And thank God I did because it's been hit hard. It's a company called Palantir. This is the spy company, the data analysis company that works with folks like the Department of Defense and the CIA. Their CEO is an absolute madman. He says the most preposterous things about how they're going to take over the world tomorrow. And of course, what happens on Wall Street, it's not what you do. It's what you do relative to expectations. This guy juiced the stock with false expectations. They had a quarter that disappointed. Now paying the price. Stay away from these promotional companies like Palantir. And so those are the ideas that I wanted to go through for this week. Now let's get into my fresh money buy list. If you're new to the program, remember our color coding screen. So first of all, these are my tech picks, right? If I didn't like them, they wouldn't be on the list at all. But I do have two categories here. In yellow, you have the companies that are on my buy list, but however, they have some flies in the ointment. And so I'm not selling them. I'm just holding them, watching. And maybe I convince myself to go back in and buy them more aggressively. But those are in yellow, right? You're at the stop sign, right? You have yellow. And then, of course, green is go. Green are my fresh money buys. So if you take a look, you have CrowdStrike, yellow, hold, wait. Still my favorite pick in cybersecurity software. My favorite pick of all is the next one. Best idea of all, Micron, and it's done very well for us. Here's a stock that I've said many times, trading for about 120 now. I think it goes to 200 at the peak of the next cycle. T-Mobile, I got it in my wait and hold, right? Everybody knows T-Mobile. And then I'm getting more and more comfortable now that we've finished the March quarter earnings reports for my big tech companies. And I'm comfortable buying all of them. That is Microsoft, that is Meta, that is Amazon, and that is even NVIDIA, although the stock is up 3 or 4-fold in the last year. And then Synopsys, SNPS, not a household name. This is my electronic design automation software play. And EDA software is the software that engineers use to design chips. I am waiting on Broadcom, AVGO, and Duolingo, I just explained. I'm disheartened by the 18% drawdown, but now I'm waiting, see if it stabilizes, and then you could probably expect me to turn green on that one. I like Dell for their AI servers, Taiwan Semiconductor, the world's most important tech company, in my view, just announced their monthly sales. This is rare because most companies only talk about their financials every quarter. Taiwan Semi doesn't give you a full P&L, profit and loss statement, but they do give you their monthly sales. And their sales between the month of April and May exploding. And so this is very good and another real tell for the AI chip makers, right? Because Taiwan Semi is where NVIDIA takes its designs to be produced. So Taiwan Semi told me a lot about semiconductor companies today, and it's all good. I think it really confirms my thesis. I've already talked about Alphabet. Booking is my favorite consumer discretionary name. Booking.com. They had a great quarter. Their key competitor, Expedia, had a crappy quarter. How can that be? Booking.com, much better company. Just like over time, Uber, much better company than Lyft. Marvell, I'm waiting to see it settle. I'm a little bit disconcerted with what's going on there. Arista Networks, I mentioned. These guys are the plumber, the data networking company to the stars, the major spenders of AI infrastructure. And then, just like I like Dell, and I might like Dell now a little bit more than I like Supermicro SMCI, but I'm buying that one all day long too. So these are my tech picks. Remember the yellow names, kind of let's wait and see, gather our thoughts. The green names, I am comfortable, fresh money buys today. So now let's take a look at some of the tech trends. All right, guys. There's actually a couple of trends I want to talk about. We always have to talk about interest rates, right? And what's happened. So right now, the yield on the 10-year Treasury note, or what we like to call America's risk-free rate, is 4.5%. And as long as we stay here and don't creep upward in the yield, that's pretty benign for tech and other aggressive growth stocks. What I worry about is inflation pressures and the Fed's unwillingness to pivot from high interest rates to lower rates takes that 10-year note to 4.8, 4.9, 5. If and when that happens, we are going to have some hell to pay, just like the last time the 10-year breached 5% back in October of last. So anyway, one of the things that happened this week, that is another data point, because we have to be macroeconomists here, was that the jobless claims for last week were 231,000, and that was much higher than expected. So why am I rooting for jobless claims to be high? Am I an ass and I want people to get fired? No, but I will tell you that if we have more data like that that shows a softening in the job market, then we'll start to say, okay, that with the recent news about the slowdown in consumer spending, maybe we do have a chance to slow down economic growth a little bit, but not go into a recession, still keep it growing at a slower pace, and then also bring down inflation. And then when those magical things happen, our central bank, the Federal Reserve Board, can finally lower rates, and we need that desperately. So here is the follow-on. The consumers finally look like they are reining in spending. Right? We had that data from Shopify, and Shopify is not as big in e-tailing as Amazon, but they're a substantial company, and they talked about the reining in of consumer spending. We'll see. We're starting to see some data points. Also, just today, we had some consumer sentiment data, and that said that when you survey consumers, they're starting to worry a little bit. And so when they worry, they spend less. So anyway, we're seeing some softening, at least this week, some new data points. Check it out. The other thing I wanted to talk about is the theme I call AI washing. Washing is in quotes. We're now through the first quarter earnings reports, and 200 of the S&P 500's companies talked about how their business is going to be revolutionized by AI. And some were tech companies, and maybe that's fair. And some were companies that have nothing to do with tech, and it was total BS marketing spin. So I tell you, be very wary, because it's easy to talk about AI on a quarterly earnings call. It's easy to put AI all over a presentation slide deck. It's not so easy to do it. And that's why I need to see more effective use cases of true AI needle-moving products. Because in the meantime, I'm just going to stick with the infrastructure builders, because the infrastructure builders will continue to do well for a couple years more with all the spending by the tech majors for AI infrastructure. I am not convinced of the AI products that will follow on, but that's okay. I can make a lot of money with the infrastructure build from 24, 25, probably even into 26 before we worry about the other side. Here is an interesting data point. Probably the best known AI product at this point is Microsoft Copilot. Now, Microsoft wants to charge you $30 per month on what you're already paying per month for Office 365 to use Copilot. Now, that product's been around for a year, and usually when Microsoft has good things to say, or when any company has good things to say, they love to crow about it. Why wouldn't you? But in their last conference call, we now had 3 or 4 quarters in a row where Microsoft dodges the bullet, doesn't talk about the success of Copilot, so makes me think that it's not successful. And they distract analysts like me, or try to, and say, well, we grew our outsourced cloud business, which they call Azure, 25, 30%. Hey, nice quarter year-to-year growth. However, 7% of that came from AI. Well, that's great. So it looks like you're getting an AI revenue kicker for your outsourced cloud support, but you're not talking about the success or failure of your own AI product. So yes, there is a derivative play here, but if they had something nice to say about Copilot, they'd say it. They're not. So I'm worried about it. Stick with the infrastructure. Do not get sucked in on any of these AI products, because I just don't know if they're going to make it. So these are some of the thoughts that I have this week. Come back next week. We'll have more. You know, it's been kind of busy the last couple of weeks because we're getting through the quarterly earnings reports. Now we'll have a little bit of a respite, right? Because the quarter doesn't end until June 30th, and we don't have another deluge of these quarterly earnings reports until about the 2nd or 3rd week of July. But I will be on top of things. If you have any questions, I'm easily found. My firm over my shoulder, easily found. And even the dudes at Benzinga can contact me. But anyway, I love working with them. This is Paul Meeks signing off on behalf of Benzinga and our director, Aaron Thomas. We'll see you next time.